Okay, good afternoon, everybody. I'm Dan Summers from Boundary Capital. There will be a couple more people, I believe, joining as we go, but I'd like to welcome you this afternoon to our thoughts on the sustainable, socially responsible investing. Pick your title, there are differences, but we'll call it SRI. And over the next kind of 20 minutes, or so, 15, 20 minutes, we'll be taking you through some of our research at a very high level. And hopefully this will help shed some light on what is a very booming market at the moment. We invite you very much to put your Q&A as we go. Hopefully everyone's familiar with Zoom at this point. And do please add your Q&A, or if there's any chat or anything strongly. We're going to be coming at the end and we're going to be drawing themes. And there's a lot of follow on here because we don't have enough time to cover all of the topics, and some of them I'm sure you will have strong views on. So without further ado, the run of play is the following. We'll talk about why SRI investing matters. I'm sure that is obvious to most of us, but it's still interesting to see the figures, what the landscape and how that's maturing, and then in terms of the investment and advisory market, what the different options are in terms of engaging with investors and for investors to engage, and then some thoughts on best practice and conclusion and Q&A, which I'm sure will be the most interesting part as we share our ideas. So we know the responsible investing market is hot. There are various metrics on this, but I'm still amazed about the size of this. The total AUM on this graph is growing at 4.7 CAGR, but the total sustainable is growing at 11.5% compound annual growth rate. And that's likely to continue, all the forecasts, and actually even subsectors within that, like the private markets, are growing even quicker. So this is hot. And if one thinks about the dot-com boom, then there are certainly analogies there, which we'll kind of reference, where it's both hot, but also some maturity happening. There's also some really interesting research from Morgan Stanley about the interest in sustainable investing. You guys may have seen this, some of you may have seen this, and again, the CAGRs are pretty staggering, 27% for millennials. Well, it's about the same growth rate in recent times, but you can see with millennials, the percentage is higher. And also some of this may surprise some of you, some of it will be well known to you, which is actually when you look at the correlations. So MSCI, hopefully as everyone's heard of that, part of Morgan Stanley. And what we're showing is that the SRI, the social responsible investing part of the market, is actually, apart from over a longer period, but in a more medium term and a short term period, it has better returns than the benchmarks and against non-SRI. And in other words, the shorthand is investing for good is good to invest. Now, no one has the kind of the answer on this, but there are lots of explanations, the way that markets are moving. And this is interesting because from 2015 to 2020, actually it wasn't so obvious. So are there recent trends that underpin? Are companies that behave in an ethical and sustainable way more attractive to invest and producing better returns in the long run? Is there less interest, etc., from consumers? We have our thoughts. You can't prove anything, but it's all the way things are heading. So what we're going to do is dig into SRI frameworks, and this is really where some of the confusion starts. And we all think about bandwagons and greenwashing. And again, if I refer to the dot-com boom, everything had a .com at the end of it, even if they were nothing to do with it, because of the wave. And that kind of helped the market, but it also made it very challenging to cut through to the things which would prosper and helped the core markets to prosper. There are many different articles, many different organizations that have different frameworks. What we've come up with are 3 frameworks. If you boil them all down, there are even one leading organization with 8 frameworks. When you boil them down, we see 3 logical overlapping sets in a sort of Venn diagram here. And there are lots of other ways to explain it, but some of them are logically inconsistent. We believe this is the only one that is logically consistent. So we talk about ESG, and we're going to deep dive into each one of these 3 areas. ESG maybe is a lot of people's window into SRI, but actually it's only one part of it. It's the compliance side really of a business, if you like, the ethical aspects of how the business operates. And I'm sure some of you will know that, but actually the more you look at it, the less, certainly the more I looked at it, the less I understood. And then there's impact investing, which is investing for outcomes. So if you like, this is where the outcome of what the business is producing or aiming to do is the important thing. So actually you could imagine a business which has low ESG and high impact and vice versa, or businesses with high impact, high ESG. And actually if companies that are early stage probably don't have the resources to be highly compliant, but actually they may still have a huge impact on the market if they're an early stage sustainable technology. And then you have another way of looking at things, which is probably some of the oldest ways of looking at this stuff, which is either excluding or screening based on specific companies, values, attributes, sectors, whatever you like. And even within, there's different ways to benchmark and set standards and so forth. And again, we'll take a look at that. There's another dimension here, which is how things are measured, and also stewardship, which is a word that's often used and meaning that, you know, one can theoretically engage with a company that you disagree with its values, but you engage with it in order to change its values. So in other words, you can invest in absolutely anything and it can be SRI if one is very cynical about this. But, you know, as long as you know underlying the methodologies, then you can navigate your way through it. And that's what we're going to try and help the conversation, the narrative today. So if we just dive into the current landscape, again, I'm sure this is obvious to a lot of people, but even as I said, when you look at it, things start to change. We have some examples of ESG criteria here. Oops. Sorry, I'm just adjusting where I am. But essentially, what you can see is the E is obviously environmental, S for social, G for governance, and this is just one framework. There are a bunch of different frameworks I've seen with different attributes. And actually, even the way these attributes are measured can vary. It could be scorecards, it could be a scale, and you know, people know about this. This is a real minefield, and you can sort of think about a company that has a very high governance, maybe an oil company, which wouldn't appeal to a lot of people, or a weapons company or defense company that have very good governance, but you know, clearly it would be extremely out of favor with people who viewed them as a sin stock, for example. You know, these things can vary enormously from investor to investor, and this is something that the advisory market is starting to become very aware of, where, you know, where we've spotted that there is an opportunity for people to share their best stories. Impact investing perhaps has a more nebulous feel to it. Even so, from the outside, it can even be for profit or not for profit. And we are strictly speaking in this about for-profit, just to narrow down the confusion. But it can have social or environmental impacts, and the way things are measured and the methodologies, you can kind of see there are a whole bunch of things trying to cross-compare different methodologies. Sometimes, in all honesty, the method is in arrears, and sometimes it shamelessly says so. Sometimes that's for the, experimental methods. We're going to invest in this thing, measure it afterwards. Mission alignment, experimental methods. A lot of the time, investors are looking for an expected return method, be it a return on social investment. Well, how is that measured? Could be a similar metric like poverty or education, or it might be something a bit more nebulous. And this is where I think when you scratch the surface, you realize that the shiny brands of some of these things are become less clear, and some are maturing quicker than others. The third bubble, if you like, in the Venn diagram is the exclusions and screening part. And you can kind of see here, I've just put some summaries that there's 4 sort of generic ways to measure excluding or screening, potentially sin stocks or sectors that you prefer. But again, the closer you look at it, the more complex and the richer it becomes, and the more choice there is for, well, cynicism on one hand, and people fiddling things to suit themselves, but also on the others, just subjectivity, both from the funds and the providers' point of view, and of course from the investors. What are they actually, do they have any red lines? What are their preferences from a motivational point of view? And you can kind of see some of the challenges that it presents to everybody in the industry. don't try to read this too much, and that's the whole point of it. These are some eminent organizations. You would have undoubtedly heard of most of them, from the UN through to the GIIN, the Global Impact Investing Network, and lots of other things in between, trying to work on the actual standardization, etc., of different metrics. And it really is an immature world with lots of very eminent organizations trying to do the right thing, and a lot of very positivity out of this. I guess crystal ball time, will it mature? Who will dominate in the future? People do look to the UN and refer to it a lot, but in our view, the UN is really talking about things for governments, not really thinking about things for private businesses. So the SDGs and the targets, again, please put your Q&As. This would be a great point of debate. When we see providers and even investors saying, I want to invest in things which support the SDGs, I sometimes think to myself, have you read the SDGs? And have you read the targets? It's not so straightforward. We understand where you're coming from. Everyone shares the same thing. But is there a methodology which derives from the SDGs that is more tangible for private businesses? Question mark. And actually, although we all understand this market is very exciting, it's there to make money, as we've shown. It's there for bigger reasons than money as well, depending on where you stand on the spectrum or as an investor where they are. But there are some challenges, like there were with the dot-com boom, etc., as I referred to, and there are some eminent people in the industry who are being quite dismissive about some of the perhaps a bit over cynical being from the inside. But obviously, I'm not putting all the positive stuff here, just to emphasize that there are things which, as an investor, as an advisor, sometimes adopting a cynical mindset is a good approach to getting to the core nub of things for the benefit of your investors. And so this mindset is a good approach, as well as all the positive stuff which underpins it. So I've kind of made everything more difficult, haven't I? Isn't everything more complicated and more subjective? Well, yes and no. The good news is, as always, that this is just this huge opportunity here. Are investors asking you, if you're an advisor or if you're an investor on this call, are you asking your advisor, or are you doing all your research directly? Is your advisor keeping you informed? Who takes the lead here? What's the frameworks to getting everybody what they want? And of course, there's a lot of advisors that I'm sure joining here that their first motivation is just to make sure they don't fall foul of any regulations, either now or in the future, about making sure that they get their investors what they want, not just the right risk profile and potentially the right returns, but actually to match what the investors really want. And it's a pretty difficult subject because it's emotive. There are different reasons and motivations, and some of this might be the obvious, but we've done a huge amount of primary research speaking to advisors and investors. And actually, it took us a while to boil it down just to these bullets. So forgive us if it sounds like the bleeding obvious. Hopefully that's a good thing. But even so, it was difficult for us to get there through the differences that we found. So, we would sort of, the first step is understand what the client, their motives and their interests, and what is the motivation, and really boil down. We have some frameworks now. Is it one of the bubbles in the Venn diagram? Do they want to change the world, or do they want to invest in companies that behave in a certain way, or do they want to exclude or add? And if they don't know, then of course there is an ample opportunity to actually set the standard and challenge your investors, or for the investors to challenge themselves as well. We have some good questions already coming in. I can't wait to have the debates later on. So we'll come to those later. Thank you for all of those. And so, when we're talking about products and funds to match, if that's part of the solution for the clients, really understanding those motives will, firstly, as an advisor, make sure that you're doing the right thing, but also more importantly, getting the investor the best thing for them and everyone in the longer term. And ensuring, here we go, the second step to enlightenment, if you like. So the solution is ensuring a fund matching these motives. And it's not just, sorry to read the words, but I think the words are important. It's essential not only to look at the strategy, but the methodology. A lot of people have the strategy. Be cynical, be curious, be robust, challenge your fund providers out there as well, get to know them as well as your investors. And if you've done that, you are elevating yourself into a position of real advisory, trusted advisor there, and everyone in the value chain benefits as well. So sounds easy to say and at a high level, but there are lots of compliance frameworks that we've seen out there. There are different ways to do it, from huge checklists to questionnaires to people self-classifying. Lots and lots of detail that in other webinars in this series, or just privately behind the scenes, anonymously with other IFAs and with wealth managers and with advisors who are happy to share those frameworks, which they are. Do come to us or talk to your peers. Best practice will get us, I think, there. So what we're going to do here, obviously, we're an impact fund provider. We're giving ourselves as an example. We don't want it to be viewed in any other context than that. There are some other, of course, great products, very robust methodologies. It's really to give an example of methodologies that you can see and touch and hopefully stand objectively, as opposed to post facto types. So Boundary, the example here we have is we have 6 themes, and those themes we've derived to match the UN's SDGs. The SDGs, sorry, I mentioned that earlier, Sustainable Development Goals, for those of you who are overwhelmed with acronyms in this space. And you can see there are 3 socials, 3 environmental. And we can go into detail, and if you're an advisor, you would challenge us in terms of how those relate to the SDGs, and hopefully we could provide answers to those, and any other fund provider that you challenged could do that as well. Some of your investors might have particular wants in this area. And then we come to a methodology, which is here we have what we call an ELI, and very simply, there's a detail behind this, but we have 3 factors that we multiply together to have what we call an equivalent lives impacted measure, which has to be over 1 million. So what is that? The first is the scale of impact. How many humans does it impact? It has to be 100 million for us or more. The degree of impact, and we have 3 orders of magnitude, for the sake of argument, low, medium, and high. And then an operating risk, again, which is an order of magnitude, low, medium, and high risk, in terms of the stage that the company is at. Now, lots of detail behind this, but you can challenge us and we can give you this formula that can actually relate to different businesses in different industries, from life sciences through to engineering to clean tech through to materials, whatever it is. We can all address the impact, because everything has an impact, even in what others would regard as sin stock. People give some people satisfaction or has a positive impact on something. It's just really a question of where you draw the line, as opposed to being judgmental on the actual thing itself. But funds will have their own different methodologies. And just to underline this with some examples from our point of view, to back that up, what you can see here are 2 of our investments that we've made. One is a wound care business, oxygenates the wounds at the bedside. These are the different, well, this is the area that it works in, the SDG that it relates to, the number of individuals that it helps. We have a primary effect, so 110 or 1 for the sake of argument, and the risk, nothing's ever 100%, but this would be at our low risk. We multiply those factors together and we get an ELI of 100 million. And this is both to select the investments, but also to monitor and report. So investors know what they're getting. And if the company drifts into a different area because of economic reasons, or just some reason, either positive or just because the business is in trouble or whatever, then we report on that, as much as we do clearly the financial outcomes, which are, let's not gloss over them. Financial outcomes are extremely important as well. Ekion is a battery technology. It's material science, improving the range and life and longevity of batteries and power density. And you can see a similar thing. We get an ELI of 1 million, so it's at our target. And there's a little diagram here. So, this gives you a window of having something to live and die by from a reporting point of view here, as well as obviously the financial objectives and how those pan out. And from a fund point of view, just as a by the way, we're looking for at least 10x in every company, and for an investor's fund portfolio, it's a 3x return in 5 years overall, blended. That's what we're looking for as an early stage B2B tech fund. So again, those financial objectives alongside the impact objectives gives you a very clear roadmap of, and you can match that to profiles and you know, if it's right or not right for your investors or as part of their portfolio, etc. So that's kind of really where we are. Just to wrap up, really, as we head to Q&A, is, you know, some of the sort of stating the obvious in so many ways, but, you know, this is a hot market. Like any hot growing market, people are sort of taking advantage, perhaps from a cynical point of view, or just maybe even from a non-cynical point of view. There is just a lot of different ways to look at this, and we need to celebrate that. And out of that celebration, the people sometimes in the middle or the investors want to cut through that confusion as quickly as possible and start to challenge, interrogate, and form strong opinions and metrics around things that are more tangible to be able to match what investors want with methodologies. And so, you know, recommendations here, and again, there's a huge amount of detail, different pro formas, different ways of doing it, spreadsheets, etc. But, you know, the headlines are perhaps obviously get really deep in the client's motives. Don't wait for them to tell you. Some may not know, or they may have, you know, may invite the challenge. And sorry, they may not know, they may not be able to express themselves as clearly, I should say, and matching methodologies there. So that's kind of where we are. Thank you for listening to the, hopefully it's provoked some thoughts. We have some good questions that have come in. So the next few minutes, we will just have a look at these. So I've got 3 questions. I'll keep everybody muted for now, but if it gets into discussion, I don't want to dominate like, you've obviously got to let people sort of speak for themselves as well. So I'll try and kind of respond a bit, and then we'll see how we get on. So question 1 is, how can we use this to advise our clients better? And I think it really follows that it's where we've kind of paused in the present. So thank you for that. Where we've got to is putting some headlines, which, you know, sound kind of the obvious, but if you want to advise clients better, then it's you can put yourself in a really strong position of clearly being informed and challenging all of the products. If you want to take them onto a panel, or if you want to know more about them as you promote them, is really taking that lid off the tin. Are there methodologies, and understanding what those methodologies are? And at the end of the day, you can set some spreadsheets and templates. You can get clients to self-classify. You can even pass on knowledge as the way that we've, obviously in your own way, the sort of presentation we've done today, so that your investors start to think about how they would self-classify. Are they after impact? Are they after ESG? Are they after inclusion, exclusion of anything? Is it one or more of the others? If you can get them to clarify those things, then you put in touch with products or recommend products where you're confident there's a methodology there. So thank you for that. Another question is, how big a problem is greenwashing in the market? And it's interesting to use the word problem. If you just said, how big is greenwashing in the market? Again, that's a really good question, so thank you. Personally, I think there are 2 ways to look at this. There's what is it's the subjectivity, if you like. So in other words, if we take away the cynicism of it, what are the different ways, or how many ways are there to actually measure the same thing? And then I think it really underpinning that comes down to who are the leaders in this field, and how many metrics do the leaders have from the Global Institute? If we go back to the slide on the different providers here, if we go back to this, you know, it's worth studying this and get to know. And we can talk you through a lot of the metrics that a lot of these people have. And of course, you can join them. You can become members of these organizations. They're very happy to share their view of the world with you. So, you know, how many different types of ways of measuring there are, we'll count this. And then there's a lot of product providers sometimes, you know, have their own methodologies, of course. So then if you want to overlay with that how big a problem greenwashing is, then you've got to take a view about how many of these things are a sort of unnecessary subjective view. it's very difficult to answer other than that, because otherwise you're then diving into what you think is greenwashing, and I'm kind of reluctant to do that. But there are some metrics out there that I can point you to about other commentators with percentages. Thank you for that question. Very provocative question there. Very interesting question. We had another good question here, which is on the similar lines. Why hasn't one global standard been agreed to benchmark ESG in SRI funds? And I think it really follows. I think that, thank you for that question, a really good question. Yeah, there's got to be all those providers that we've seen before that are trying to do their bit to help. They're all coming from a slightly different perspective, and a lot of them will measure ESG. ESG is kind of getting used a lot as a substitute for SRI without being really clear that it is just a part of it. And then, of course, everybody wants to measure ESG for their own benefits, as we've said. So it is just the nature of an immature market. Now, some of you will be aware that there are standards, there are big committees who are getting together. Some of the big four are trying to lead on this, certainly for big equities, investing in equities. They're trying to standardize. In the mid-market and private investing, it's very difficult, and it's also very difficult for the reasons mentioned before, which is that small companies don't necessarily have the resources. And actually, as an investor, do you really want them to be spending resources on measuring everything? Would you want a small company to adopt the same principles as a large company? So, you know, there are a great number of very structural issues also we address here. So I know it's not a completely direct answer to a very good question, but I think if I were able to sort of say in 5 years' time, will there be less standards or more? I would say that there will be less, because there's so much money. There's already some fallout happening. You've seen some comments made, and a lot of big companies now, the bigger space, particularly with ESG, and then the likes in the mid space and smaller space, where these structural issues are being recognized, and people like Benchmarking Alliance and also the GIIN are looking at that more closely and trying to navigate and take some leadership there. So that would be the way I would answer that question. So we have a few more, but they're similar sort of themes. So what I will do is to thank you very much, all of you, for joining. Clearly, we can have more of an open debate, I think, in a longer time period, but please do get in touch. My contact details are on the screen, and you're welcome to call me. As I said, we will be doing more webinars on this topic, diving into the detail which we've not been able to go over today. And also, if you want some of those details, anonymized methodologies, the way that some other IFAs or advisors or investors categorize themselves or navigate through, we'd be very, very happy to put you in touch with other people where we think there's best practice or good practice to share. So please do get in touch. If we all work together to clarify this industry, it will grow even quicker, and you'll get even happier investors as well, which will benefit everybody in this space. So thank you very much, and please do get in touch, and I'll see you hopefully in another webinar sometime in the future, if not in person soon. Goodbye.